I have covered the subprime loan market a number of times in the last 12 months. Let me talk about the other shows first if you want to look these up for reference. So almost a year ago on February 13th, 2019, I covered a show, a record 7 million Americans are 3 months behind on their car payments. And then again in November 2019, I covered the show that the sales for U.S. and global auto sales are in a giant nosedive for over 12 months now. With that being said, as you can see there on your screen, recently there's been a story out by Wolf Richter of wolfstreet.com, and he's talking about subprime auto loans are still growing, and the mainstream media, the U.S. government statistics are spinning the car loan sales. So the Seeking Alpha headline that came out last week on February 12th was that auto lenders are doing great. They cap off 2019 with a very strong Q4 2019 origins. That auto lenders finished 2019 with robust origination growth, even as new vehicle sales declined, with Santander Consumer Holdings making record high auto originations for the year. That the Q4 total auto originations of $7.5 billion increased 9% year over year, with loan originations from Chrysler Capital up 29% to $3.2 billion. Capital One Financial increased their Q4 auto loan origination volume by 27%. JP Morgan's Chase Auto originations, including car loans and leases, increased 21% in the fourth quarter of 2019 to $8.5 billion. Wells Fargo increased auto originations 45%, to $6.8 billion, helped by the lender's total auto volume. Ally Financial and GM Financial's Q4 lost some luster. GM Financial loan originations actually sunk 35%. But the GM stock didn't collapse. I'll talk about the GM stock in a little bit. And Ford Credit posted its best annual earnings in 9 years, with 2019 earnings before taxes of $3 billion, up 14% year over year. The company didn't release their Q4 origination numbers. So that's the positive spin on the auto market. The reality of the situation, I would say the Federal Reserve is definitely worried in this Wolf Richter article that he's highlighting there. And then there's an even crazier Wall Street Journal article that came out a couple days ago called, and I'll read that in a little bit, by Anna Maria Androitis and Ben Eisen, called "Dealerships Are Giving Car Buyers Some Advice. Just Stop Paying Your Auto Loan." You cannot make this stuff up. I don't think I could make this stuff up if I tried. So let me read the Wolf Richter article first. Subprime auto loans explode, serious delinquencies spike to record, and in spite of this, the stocks that I was looking at, whether that's General Motors, Ford did have a drop of about $1 a share from early February, so Ford did considerably drop. Remember, Ford's credit was also downgraded to junk. I want to say in November, maybe. It was sometime late last year in 2019. But some of the other stocks in the auto industry that are related to either used car, subprime auto, or auto loan, like Credit Acceptance Corporation, which is CACC, Charles Charles, that stock it hasn't crashed. It's stayed fairly high. I mean, it got as high as $491 a share on September 18th. Yeah, that was its high, it looks like, over the last year. And now it's down to 434. So it's in a range. I mean, it hasn't crashed. And a lot of the articles that have come out on that have looked to be positive. CarMax has not crashed. CarMax looks to be, let me pull up a long-term chart of CarMax real quick. Wow, yeah, CarMax looks to be in an all-time high. CarMax which is KMX. So that's Krispy Kreme, Mike, Xavier, CarMax. CARMAX is the company. That's at an all-time high at $101.90 a share. That's up almost 2% today. So it's ignoring all of this other data. Again, just like how Apple ignored the Cerveza problems in China, the guidance, Apple stock didn't crash on that. And then yesterday when I covered that show with HSBC Bank, and in spite of all the negative things with HSBC Bank, that stock is only down about $1, despite absolutely bombing Q4 earnings. With their net profits were down enormously. I think net profits were down over 50%, and their pre-tax profits were down over 35%, I want to say. So back to this article here. So nearly a quarter of all subprime auto loans are 90 plus days delinquent. Why? Auto loan and lease balances have surged to a new record of 1.33 trillion. Delinquencies of auto loans to borrowers with prime credit rates hover near historic lows, but subprime loans, borrowers with a credit score below 620, are exploding at a breathtaking rate, and they're driving up the overall delinquency rates to financial crisis levels. Yet these are the good times, and there is no employment crisis where millions of people have lost their jobs. Not yet, anyway. If oil prices stay low, a lot of people driving those pickup trucks on leases or barely able to make the payments in the Midwest or South that are working oil jobs, they're going to be in trouble. All combined prime and subprime auto loan delinquencies that are 90 days or more past due, quote, serious delinquencies, in the fourth quarter 2019 surged by 15.5% from a year ago to a breathtaking historic high of 66 billion, according to data from the New York Federal Reserve released last week. The article came out on February 13th, so it said today, but that was last week, a week ago. And remember, this contrasts very, very heavily to the mainstream financial spin that I just read on Seeking Alpha about all this loan origination growth and subprime loan origination growth being good for the car dealers, for the auto loan companies, for the car manufacturers, etc. Okay, back to the article. There is a really good chart. You can see part of it on your screen. I couldn't fit the whole thing without drastically shrinking it, but the chart in there shows basically it's a parabola after, it looks like it's just going vertical in the second quarter of 2014. So the subprime auto loan delinquencies just started going absolutely nuts in the second quarter of 2013. It's almost the degree of the angle going, it's unbelievably almost straight up. You can take a look on the article later in the information and description section. It'll be below the video on the replay. Loan delinquencies are a flow. Fresh delinquencies that hit lenders go into the 30-day basket, then a month later into the 60-day basket, and then into the 90-day basket. As they move from one stage to the next, more delinquencies come in behind them. When the delinquency cannot be cured, lenders hire a company to repossess the vehicle, and then they start calling you nonstop, right? They sell your auto loan to like one of those credit collection agencies. So your credit report gets hammered, but then those credit collection companies are calling you nonstop, trying to get you to pay. Finding the vehicle is generally a breeze with modern technology. The vehicle is then sold, because you got LoJack and those other things. The vehicle is then sold at auction, a fluid and routine, the other competitors to LoJack, and then there's also GM's OnStar system and others. Vehicles then sold at auction, a fluid and routine process. These delinquent loans hit the lender's balance sheet and income statements in stages. In the end, the combined loss for the lender is the amount of the loan balance plus expenses minus the amount obtained at auction. On new vehicles that were financed with a loan-to-value ratio of 120% or perhaps higher, losses can easily reach 40% or more of the loan balance. On a 10-year-old vehicle, losses are much smaller. As these delinquent loans make their way through the system and are written off and disappear from the balance sheet, lenders are making new loans to risky customers, and a portion of those loans will become delinquent in the future. This creates that flow of delinquent loans, but that flow has turned into a torrent. Seriously delinquent auto loans jumped to 4.94% of the 1.33 trillion in total loans and leases outstanding, above where the delinquency rate had been in the third quarter of 2010 as the auto industry was collapsing, with GM and Chrysler already in bankruptcy and with the worst unemployment crisis since the 1929 Great Depression approaching its peak. But this time, there is no unemployment crisis. Because most people are working like multiple jobs just to make ends meet. These are the good times, I'll put good times in air quotes. The article doesn't have that. Okay, about 22% of the 1.33 trillion in auto loans outstanding are subprime, so about 293 billion are subprime. Of them, $68 billion worth are 90 plus days delinquent, which is not mentioned in any of the positive spin on Seeking Alpha or any of the other PR headlines talking about how many subprime auto loans are delinquent. It's all spun positively for loan origination growth, not mentioning how 30, 60, 90 days later, those loans are all going bad at a very rapid pace. So back to the article, this means that about 23% of all subprime auto loans are seriously delinquent, nearly a quarter. Subprime auto loans are often packaged into asset-backed securities and shuffled off to institutional investors such as pension funds. My God, it's amazing how the mistakes are repeated. And again, we go back to problems with pension funds, and I've talked about this at length. Real Vision TV has a bunch of interviews out in the last week or two about the pension fund crisis. There's a lot of long interviews there. I don't know if they've released more than one or two for free, but it's well worth the subscription behind the paywall if you want to really dig into this topic. But this goes back to central banks and financial repression. And we're living in a stagflate and tax and lie environment. So almost everyone's cost of living is rising, and most people's income is not rising. And if you're a retiree or a saver or a pension fund and you need more income, and the central banks are manipulating interest rates lower, so big governments and large corporations do not have to go bankrupt or do not have to cut their budgets or do not have to fire people, then you have a situation where these pension funds are desperately going to be reaching further and further out the risk curve for any type of income, which is very, very dangerous. Okay, back to the article. So this is an unintended consequence. These subprime auto loans, this is an unintended consequence of this central bank and big government scheme of financial repression and trying to maintain the status quo, that the retirees and savers and pension funds cannot get income, cannot get the yield that in the past they could have gotten at a lot less risk. In the past, people could have gotten 5% or 6% on their savings in a savings account or on a treasury, on a U.S. treasury. 15, 20 years ago, 5% or 6% on a treasury was not unheard of. Now it's not going to happen again. It's not going to happen until the system collapses or resets or there's a new system. Okay, back to the article. These securities have tranches. Oh, here we go again. Tranches of garbage. Tranches of toxicity. Toxic sausage. Tranches ranging from low-rated or not-rated tranches that take the first loss to AA or AAA rated tranches that are protected by the lower-rated tranches and generally don't take losses until a major fiasco is happening. So almost exactly the same setup here as mortgage-backed securities leading into the 2008-2009 financial crisis. Yields vary. The riskiest tranches that take the first loss offer the highest yields and the highest risk. That makes sense. Highest tranches offer the lowest yields. So the highest and safest, in air quotes, tranches offer the lowest yields. The subprime auto loan ABS, or asset-backed securities, are now experiencing record delinquency rates, which are not mentioned in any of the Seeking Alpha articles. Delinquency rates are highly seasonal, as the chart below shows. In January, the subprime 60-plus day delinquency rate for the auto loan ABS rated by Fitch rose to 5.83%, according to Fitch Ratings, the highest rate for any January ever, the third highest rate for any month, and far higher than any delinquency rate during the financial crisis. But subprime auto loans are experiencing historically low delinquency rates. Why are subprime delinquency surging like this? It's not the economy that will come later when the employment cycle turns and people lose their jobs, and those delinquencies they may lose their jobs with the global supply chain. If the pervasive problems in China continue for another month, 2 months, 3 months, some of these businesses are going to be out of cash. So unless there's unbelievable amounts of emergency liquidity injected even more than normal, and there's already a lot, maybe emergency bailouts or something, it's looking like some of these Chinese firms in the next 1 to 3 months are going to be out of cash. I've just been seeing more and more articles, more and more studies about this, that especially in Wuhan, there are a lot of auto part suppliers. So the pervasive problem is particularly acute in Wuhan. Also, a lot of the originations for pharmaceutical drugs in Wuhan. So people who have like diabetes drugs and some of these others, in a couple months from now here in the West, those drugs could run out. The inventory levels are going to be low on those. So just FYI. It's how aggressive the subprime lending industry has gotten. Oh, wait, let me see here. Did I? Okay. Yeah, I'm in the right part. It's how aggressive the subprime lending industry has gotten. Yes, when Seeking Alpha is issuing press releases about the more auto loan originations, the better. And how they've been able to securitize these loans and selling the ABS into heavy demand from investors desperate for yield, I'll add, who have gotten beat up by the negative interest rate and low interest rate policies of central banks. These investors have been madly chasing yield, and their demand for subprime auto loan asset-backed securities has fueled the subprime lending business. Subprime is a very profitable business because interest rates range from high to usurious, and Consumers with this credit rating know that they have few options and don't negotiate. Yes, because the goal of a lot of people like that is they will take the auto loan, and as long as they can make the payments, it's fine. They don't care about paying off the principal. There was an interesting show on Dirty Money about a payday loan company where they had recorded telephone conversations about this. So if you're interested in that, again, the Dirty Money series on Netflix, really, really good. They had a HSBC Bank one. They had a payday loan one. Supposedly the second season of that documentary series is coming out in the next 2 weeks. I think mid-March 2020. Often they might not do the math of what they can realistically afford to pay each month and why they should. If the dealer puts them in a vehicle, all they have to do is sign the dotted line. So profit margins for dealers, lenders, and Wall Street are lusciously and enticingly fat until the thing goes in reverse. Subprime lending, and it's a game of hot potato. Remember, they got to dump all this garbage, all this toxic sausage. They got to dump as much of it as possible onto the pension funds, the suckers, the large pools of capital that are not smart money, before the musical chairs ends, before the game of hot potato ends. Subprime lending, legitimate business. Subprime lending is a legitimate business. In the corporate world, the equivalent is high-yield bonds or junk bonds and leveraged loans. I also don't like leveraged loans. Netflix and Tesla belong in that category. The captive lenders such as Ford Motor Credit, GM Financial, Toyota Financial Services, etc., or credit unions take some risks with subprime-rated customers, but generally don't go overboard. The most aggressive in the sector are lenders that specialize in subprime lending. These lenders include Santander Consumer Credit, Credit Acceptance Corporation, and many smaller private equity-backed subprime lenders specializing in auto loans, which I read the Seeking Alpha press release talking about how good loan originations are for Q4 2019. So this is like hashtag facepalm, that it's going to keep getting spun positively, that all these new loans, a lot of them subprime, is still expanding until the defaults start to rapidly spike. I mean, we've already had a big spike in defaults, but maybe there's an even larger spike, and the game of hot potato and musical chairs ends, and they can't dump all of this toxic sausage derivatives products, these asset-backed securities filled with potentially ticking time bomb exploding auto loans, subprime auto loans, onto pension funds, which will turn from an asset into a liability. Okay, and big write-downs. And they eat some of the losses and they retain some of the... Okay, wait a second here. I went off on a tangent and I lost my place here. Specializing in auto loans, some sell vehicles, originate the loans, and either sell the loans to banks or securitize the loans into asset-backed securities. And they eat some of the losses as they retain some of the lower rated tranches of the ABS. Some banks are exposed to these smaller lenders via their credit lines. The remaining losses are spread around the world via securitizations. This isn't going to take down the banking system through a few small specialized lenders have already collapsed. But demand for subprime auto loan asset-backed securities remains high, desperate for income and yield. And as long as there is demand from investors for the asset-backed securities, there will be supply, and losses will continue to get scattered around until a decline in investor demand imposes more discipline. Okay, now let me read if you think that was bad, let me read the really crazy part. This is the Wall Street Journal article. First, let me take a water break for a second. The Wall Street Journal article is nuts. Okay, so this Wall Street Journal article came out 4 days ago from Anna Maria Androitis and Ben Eisen. Dealerships give car buyers some advice. Just stop paying your auto loan. Oh my God. Joyce Parks was struggling to afford her Kia Soul when she says the dealership where she had bought it pitched her an unconventional idea. Stop making the payments. Ms. Parks, 63 years old, says employees told her that she couldn't trade in the Kia Soul, but that she could buy another car. To get rid of her vehicle, the dealership told her she should have the lender repossess it. Ms. Parks said, the trade-in whereby a buyer... I know, this just sounds ridiculous. The trade-in whereby a buyer hands a car back to a dealership and uses it as credit toward another one is often a crucial step in car buying. But some dealerships are instead telling buyers to give their old cars back to their lenders and selling them new ones in a practice known as, quote, kicking the trade. Interesting. It is difficult to... Interesting what they decided to call it. It is difficult to estimate how often this happens, but if they're reporting on it, clearly it's starting to become popular. Auto sales veterans say the practice is an open secret now in some showrooms. Broadly, vehicles are getting more expensive and Americans are struggling to afford them. Dealerships now make more money arranging financing than selling vehicles. That's because if people just pay the minimum on a lot of car payments, it could take them many, many years to pay off the car loan. So that's why if you finance a car loan and you just make the minimum payments, it's going to take you a really long time to pay off that car. So that's why they make more money off the car loan than the car. If a car loan goes bad, it typically isn't the dealership on the hook. It is the borrower or lender. The National Automobile Dealers Association said there is no evidence to suggest, quote, kicking the trade is prevalent. Of course they would suggest there is no evidence to suggest that it's prevalent. In spite of people who are actually gathering this article, why would they write it if it was they just said it was an open secret? So I guess this is the denial confirmation? Yeah, the confirmation denial. The denial confirmation. I got the right time. Got it right the first time. Dealerships, quote, could not sustain carefully cultivated relationships with lenders if they were to engage in the type of behavior alleged, a spokesman said. Consumer lawyers, actually they could, because they're going to dump that stuff onto the pension funds, right? So as long as they're dumping it, this toxic garbage, onto the pension funds, and everyone's making money all the way, the middlemen, the car dealers, the middlemen, the people chopping these auto loans up and packaging them, as long as everyone makes money but the pension funds, this is win-win for that industry. Consumer lawyers say they have seen more such cases. 5 years ago, quote, it happened 2 or 3 times per year, which I don't believe, said Daniel Blinn, a Connecticut-based attorney who has sued dealerships and auto lenders. Quote, now we hear it at least once per month. Credit reporting firm TransUnion calculates that nearly 24 million U.S. vehicle loans were originated in 2018. About 300,000 of those vehicles were repossessed within 12 months, up 17% from 2014. Such a quick souring of the loan can be a signal of some sort of auto fraud. Roughly a fifth of people who have had a car repossessed over the last several years take out another auto loan within a year of the repossession. TransUnion says dealerships typically don't make loans. When consumers need financing, a dealership electronically sends their loan applications to banks, credit unions, and other lenders. They in turn decide whether to fund the loan. Problems often begin with consumers who buy cars they can't afford or sign loans they don't understand. But dealerships can compound the trouble. Some dealerships are inflating borrowers' incomes or on loan applications, very similar to the mortgage-backed security subprime housing crisis prior to 2008-9, how it went on for years prior to 2008-9, where you had stories of people with no income, no job, no assets, or very low income who had 3, 4, 5, 6 properties with almost no money down, and for a while they made a lot of money, and then it went in reverse and they went bankrupt. Well, they strategically defaulted. Some dealerships are inflating borrowers' incomes on loan applications. They can sell them bigger or more expensive cars, according to lawsuits and interviews. When dealerships kick the trade, they typically get a lender to approve a loan for the buyer's new vehicle. Next, the buyer generally goes home with 2 vehicles and 2 loans. It is only then the buyer asks the original lender to repossess the original car. Connex Credit Union sued Connecticut dealership Barberino Nissan in 2016, alleging the dealership repeatedly told customers to just deliver the keys to Connex. Barberino denied the accusations, but agreed to a settlement roughly a year ago, according to the dealership's lawyer. Lenders generally say they will cut ties with dealerships that do this, often though the lenders aren't aware it is even happening. Ms. Parks, a former dietary aide in Gastonia, North Carolina, said she told dealership employees she couldn't afford the used Nissan Rogue they wanted her to buy. She said she signed a bank loan for it because she felt out of options. Ms. Parks then told Kia Motors Finance, the lender of her Kia Soul, she wanted to return it. The dealership told her not to mention she had just bought another car, she said. Wow. This is a scheme, folks. This is a crazy scheme. And everyone's just looking the other way because most of the people involved in this are making lots of money, lots of commissions. This sounds very, very similar to the subprime housing crisis and the ninja loans and the subprime auto loans and the no-doc loans where people didn't have proof of income or they had their income was inflated on the loan documents, stuff like that. Very, very similar to a lot of the shenanigans, the tomfoolery that happened here in the U.S. in the housing crisis, well, the housing bubble, and then the crisis that followed. After a few months, Miss Parks couldn't make the payments on her Nissan Rogue either. It was repossessed too. Miss Parks now drives a used Nissan Murano her family bought her. Her credit score has plunged. She owes at least $15,000 on the Kia Soul and the Nissan Rogue, according to her credit report. She is suing the dealership Kia of Gastonia. It shut down last year. A lawyer for the dealership didn't return requests for comment. Wow, that is really shady stuff. When a lender takes back a vehicle, it typically tries to sell it, but that is often not enough to cover the outstanding loan, because people end up owing more money than a used car is worth. That's why you need to know finance. That's why you need to know the basics of personal finance. You got to be careful about these car loans. Sometimes borrowers don't realize they're responsible for their remaining debt, even if they get rid of the vehicle tied to it. Perla Amante of Hawthorne, California, struggled to pay for her Kia Sorento after her husband died in 2018. At her dealership's instructions, she said she signed a loan for a Kia Forte and then called the Sorrento's lender, Ally Financial, which I think General Motors, that's GM Capital, I think that spun off, to say she no longer wanted it. Ally told her she would be billed for the amount left over after Ally resold the car. Miss Amante, 70, a retiree who worked in customer service, said the dealership hadn't mentioned this risk. She contacted a lawyer who got the dealership to take back the Kia Forte. When Whitney Davis's Hyundai Sonata was having mechanical problems in 2016, she returned to the Connecticut dealership where she bought it used. The dealership told her it would take the car and sell her another one, she said, but after she signed a loan for a used Nissan Altima, she was told she couldn't trade in the Sonata. When she explained she couldn't afford 2 car loans, an employee told her to have the Sonata's lender take it back. Quote, he made it seem like it was something they deal with a lot, said Miss Davis, who is 29 and an office manager. The Sonata's lender took back the vehicle and soon informed Miss Davis she still owed nearly $9,000. Her credit score plummeted. You know, the more I'm hearing about this is definitely a scam. This is a really bad scam. It's pervasive. The more I'm hearing about this, even a few of these cases, it sounds like it's all over the country. And none of these auto stocks are pricing in any of this. No one seems to care. Because you don't see any mention of this on Seeking Alpha, on any mainstream finance websites. The Sonata's lender took back vehicles soon before, still owed $9,000. Her credit score plummeted. And owner of the dealership, Carnation in Middletown, Connecticut, I think Carnation might compete with CarMax. So CarMax probably does this too. Pleaded guilty in federal court in December to a charge related to giving false information about loan applications to auto lenders. Trent LaLima, an attorney for the owner, said his client didn't cheat any car buyers and would never have tolerated any such activity. Sure. The dealership has shut down. An attorney for the dealership disputed Miss Davis's account but wouldn't give details. Miss Davis recently got a loan for a used Jeep Grand Cherokee. I love how they spun it there that she still got a car loan here at the end of this article. And then a couple more articles that came out. I won't read these, but this article came out on Tuesday of this week that Chinese cities screw that one up. In Cerveza problems now, Chinese cities begin subsidizing car purchases to resurrect auto market from the dead. So if you want to read about that, it'll be in the information and description section. And then this seems to be more honest. The EU auto registrations in the European Union have plunged in a pre-Cerveza problem, January auto numbers. Oh yeah, I forgot to talk about General Motors. So let me look at a chart of General Motors here. General Motors looks like it may have put in a top on July 24th, 2019. Stock got as high as $40.88, and it's been pretty volatile since then. It was volatile before that, but GM had been rallying a lot. I know David Einhorn bought it as a turnaround play. He bought General Motors as a turnaround play a number of years ago and did well. I think he made a lot of money in General Motors, but I think the articles are coming out here on Seeking Alpha saying that he just started selling a lot of his General Motors shares. This came out on Monday. Greenlight Capital trim stake in AirCap Holdings, Altus USA, and I think General Motors. And then also their Morgan Stanley, an investment bank, which is probably biased, and General Motors is probably one of their clients, sees that General Motors shares could double in a bull case. This is from last week. Well, 10 days ago, February 10th. So General Motors is starting to get fairly volatile. Let me look at the more short-term charts. Yeah, it's just range-bound. It is making lower highs, though. The rallies look to me to be faded a little bit lately. Okay, I'll look at listener questions and comments. Jonathan asks, if I sign up for Patreon, do you answer emails from members if you have questions regarding articles behind the member paywall? Okay, so in the member paywall, there, if I post an audio podcast or an article, and hopefully either tonight or tomorrow, I will be able to get out that oil podcast. I wanted to do it yesterday, but after these long shows, sometimes I just have headaches. I have migraines for a while if I speak too long, and then my voice could go. So I want to give you guys the best stuff possible behind the paywall. But with the articles and the audio podcast, there's a comment section, and I do answer the comments. And you can send me messages through Patreon, and I do I can't respond to all of them because I have hundreds of messages, but I do try to respond to most of them. Okay, Brian asks, wouldn't CACC get the brunt of the fallout? They might. They're looking like Angelo Mazzillo from Countrywide. That's what they're looking like. You have a bunch of players in this. Banco Santander is very big in subprime auto. They bought HSBC's subprime auto loan book, if I remember correctly. Yeah, Santander Consumer Holdings. Yeah, that was the first one mentioned here in the Seeking Alpha press release. Banco Santander would be another way. Look, we're in an environment where some of these banks, if they have really bad subprime auto loan books, they may get bailouts too. So I don't know if any shorting is going to work. I mean, the stuff General Motors, their auto origination dropped 35%. So that's interesting. That General Motors is not selling now with cheap oil prices because they have all these trucks. That's particularly interesting to me. Actually, that was Q4, so oil was rallying then. So oil was still rallying in Q4 2019. So oil was going up. Maybe that's why people didn't buy as many trucks. Oh, I got a super chat. Thank you, Greg. I appreciate it. No, it's tough to say if CACC is going to get the brunt of it. I mean, there's real shenanigans there. I've looked into CACC's financials in the past, and they have a way below average default rate. Like, they're doing an enormous amount of subprime auto loans, and they have a way lower than industry average default rate. So either they are the best underwriters for subprime auto loans in the history of the world, and they're better than their competitors by a wide margin, or there's fuzzy math there and a lot of red flags. But just because there is accounting fraud doesn't mean it's a good short and it's going to collapse. Again, I would avoid this for now because the market is not reacting to any the car companies, and any of these subprime auto lenders are not reacting to any bad news at all. It's just like HSBC Bank. You know, in this environment, enough money may be printed, enough high-frequency trading algorithm manipulation, plunge protection team, whoever. Maybe the plunge protection team is protecting government motors again. They don't want have to do another bailout. I don't know. But in this market environment, I don't know if any shorts are going to work. I mean, I have friends with a lot of hedge fund managers who used to be very good short sellers, and most of them have lost unbelievable amounts of money for the last few years. So shorting, at least for the short term, a lot of it may be dead. Governments want those capital gains tax revenues on the long side. I got another super chat. Thank you, Octavio Hernandez. So yes, Jonathan, there is comment section below the audio podcast and the articles I write, and I do try to I can't respond to every single comment because literally, I mean, there's over 100 comments below every single YouTube video, and I have 1,300 YouTube videos, and I get 40 emails a day, so I can't respond to every single one. It's really difficult, but I do try to get to some of them. I try to spend about an hour or two a day doing it. DJB nails it here. Dealers make less and less profits from car sales, so they make it up on the financing. Exactly. Anyone have DJB says, anyone have any buns for the toxic sausage? Why would you want to eat toxic sausage voluntarily? No buns, no sausage. Not for that stuff. No, thank you. IBGI says there was a time when if you didn't qualify for a loan, you didn't get a loan. Now, if you don't have good credit, you can get a house, a car, anything you want. This only is predicated on the fact that those loans can be chopped up into toxic sausage, repackaged, and then sold as higher interest investment products to pension funds. That is the only way that scam works. And everyone all along the way, except for the pension funds, is making money. Now, the pension funds may make money initially. Right now, the subprime auto loans are still paying. The collateralized loan obligations are still paying. Eventually, those assets will turn into toxic liabilities. Oh, yes. Hit the like button. I forgot to bring that up. Yeah, I focus on the content. I always forget to ask to hit the like button. Okay, well, I think that's it for this live stream show. I want to thank my almost 300 now Patreon account contributors. It's growing really, really rapidly. I'm getting a couple a day now. Starting to really go gangbusters the last 6 to 8 weeks. I went over 250. Went from 200 to 250 really quickly. Went from 250 to 280, I think. Something like that in the last week. Really, really quickly. So I might be over 300 now in the next month or two. Less than 6 months, the way things are going. So that's really, really good. Allows me to focus on content like this. Then I don't have to worry about Google AdWords revenues. Thank you very much to my dozen or so monthly PayPal contributors and people throw me a tip with a cryptocurrency once in a while. It's much appreciated. And hopefully my voice is good enough so I can go and do that audio podcast behind the paywall for my Patreon account contributors about the oil market.